When you think about any successful business, from a tiny startup to a global giant, it really comes down to a series of high stakes money decisions: how they invest, how they raise cash, and what they do with the profits. You get these right, you create incredible value. Get them wrong, well, the consequences can be pretty brutal. So let's open up the playbook that guides these absolutely critical choices. $12 billion. Just let that sink in for a second. That's the mind-boggling amount India's Tata Steel paid to buy the European steel company Chorus way back in 2007. I mean, this was a massive, massive financial move, one that would change everything for both companies. Seriously, how do you even wrap your head around that? Where does that kind of money even come from? How do you know for sure that it's the right move? And how on earth do you calculate the risk on a deal that could literally make or break your entire company? Well, as crazy as it sounds, a decision that huge actually boils down to a core set of principles. These are the fundamental questions that every single chief financial officer, the CFO, has to answer day in and day out. It's the very foundation of what we call financial management. So, here's our game plan for this explainer. We're going to start with the big goal behind that $12 billion question. Then, we'll break down the three core decisions every CFO makes: investment, financing, and dividend. And to wrap it all up, we'll see it all come together in that classic financial tug of war: debt versus equity. Okay, so before a CFO even starts thinking about how to spend money or where to get it, they have to be absolutely crystal clear on the why. What is the end game here? What's the ultimate goal of all this complex financial wizardry? And there it is. It's not about having the biggest sales numbers this quarter or the fanciest new headquarters. The number one, top of the list goal is to maximize the wealth of the people who own the company, the shareholders. And in plain English, that just means making choices that drive up the market price of the company's stock over time. This visual right here, it says it all. That rising stock chart is the end game. Every single smart financial decision should add value, and that value shows up in what people are willing to pay for a piece of the company. A rising share price is basically the CFO's scoreboard. It's the clearest sign that they're making the right calls for the owners. Now, what I love about this is how it simplifies everything. The road to making shareholders wealthier runs through three main gates, and the CFO holds the keys to all of them. This is our roadmap for the rest of the way, so let's jump into the first one. All right, first up, and you could argue it's the most important one, the investment decision. Every company has a limited pile of cash, right? So the question becomes, where do you put that money to work so it grows into an even bigger pile? It's all about placing your bets wisely. So it all comes down to choices. Do you build that shiny new factory? Do you pour millions into launching a new product line? Or maybe you go out and just buy one of your competitors. The investment decision is all about picking the projects and assets that you believe will generate the most bang for your buck. And these decisions really come in two flavors. You've got the big ones, the long-term stuff we call capital budgeting. These are the high-stakes, bet-the-company moves that you often can't take back. Then you have the short-term decisions, managing the day-to-day stuff like cash and inventory. But for either one, the CFO is always asking two main questions. One, how much cash is this thing going to generate for us? And two, what's the potential rate of return? Okay, so you've made your investment decision. You're going to build that factory. Awesome. Now comes the second giant question. How are you going to pay for it? And that brings us to the financing decision. So a company basically has two main piggy banks it can raid for cash. It can use money from the owners, which we call equity, or it can use borrowed money, which we call debt. The whole financing game is about finding the perfect cocktail of those two to pay for everything. And wow, the trade-offs here are huge. Equity is safer for the company, right? There's no legal obligation to pay it back. But, and it's a big but, you're giving away a slice of ownership, a piece of control. Debt, on the other hand, is risky with a capital R. You have to make those interest payments no matter what. But it's usually cheaper than equity, and the original owners keep full control. It's a constant, delicate balancing act. Okay, let's fast forward. Your investment and financing decisions were genius. The new factory is humming along, products are flying off the shelves, and you're making a profit. Now the CFO faces that third fundamental choice. What do we do with all this cash we just made? This is the dividend decision. Do you hand those profits back to your shareholders as a cash reward, that's a dividend, or do you keep the money inside the company as retained earnings to plow back into new projects for even more growth? Is it cash in their pockets today, or a potentially bigger payday for everyone tomorrow. And there is no single right answer here, because this decision sends a powerful signal to the market. A company that holds on to its profits is basically telling investors, hey, we've got so many amazing growth projects, we can make more money for you by reinvesting this cash than you could on your own. A company that pays a big, steady dividend is signaling stability and confidence. It's a huge strategic choice about the company's future. All right, now let's put it all together. We're going to zoom in on that critical balancing act we've been talking about, managing the company's mix of debt and equity. This is what's known as its capital structure. Your capital structure is basically the financial foundation of your entire company. It's that precise recipe of debt and equity you're using. If you get that mix wrong, if you take on way too much risk or you're too conservative, the whole thing could come tumbling down. Getting it right is absolutely crucial. Now, here's where things get really interesting. Using debt can be an incredibly powerful tool. It's a concept called financial leverage, or sometimes trading on equity. The idea is brilliant and simple. You borrow money at, say, a 10% interest rate, and you invest it in a project that earns a 13% return. That 3% difference, that's pure extra profit for the shareholders, all made using someone else's money. Okay, just look at this table. This shows you exactly how it works when everything goes right. See Company X? Notice how their operating profit, that EBIT line, is the same in all three scenarios. But as they take on more debt, look what happens to their earnings per share, the EPS at the bottom. It goes up from 0.93 to 1.40. And why? Look at the very bottom line. Their return on investment is over 13%, but that debt only costs them 10%. That's leverage working its magic. But, and this is a huge but, here's the dark side. Here's what happens when leverage goes wrong. Look at Company Y. They do the same thing, take on more debt. But watch their earnings per share. It completely collapses, falling all the way to zero. Why? Same reason, just in reverse. Their return is under 7%, but they're still stuck paying 10% on that debt. The leverage that was their best friend before is now destroying shareholder value. So what's the big lesson here? The goal isn't just to blindly juice your EPS numbers by piling on debt. Not at all. The real art is finding that optimal capital structure, that perfect sweet spot. It's the specific blend of debt and equity that balances the power of leverage against the very real risk of it blowing up. All with that one single goal, making the value of a single share go up. Which really leaves us with one final thought to chew on. In a world where everything is always changing, interest rates, the economy, what your competitors are doing, is there really a single, perfect, set-it-and-forget-it formula for this stuff? Or is the true job of financial management more like a constant quest, always adjusting, always tweaking, forever chasing that moving target we call optimal?